So take out question number 21. QA is in the process of computation of deferred taxes as per applicable Ind AS and wants the guidance on the treatment of following alternative items. The QA does not have a taxable income as per a tax laws. So your tax profit is 0, because of which you pay MAT on your book profit. Okay, there is some provision in the taxation. You don't have a taxable profit, pay minimum tax, and the day you get the profit, we will give you this deduction of the whatever tax you paid. No, we will give you. It's like an advanced tax type of thing. Now you can carry forward the MAT for next 10 years, and the company's projection submitted to its banker is in the process to get the credit for the same by the end of 8th year. Now somewhere projection says that yes, you can recover this money. The company is recognizing MAT credit as per current assets. So what is the set of journal entry for a MAT? Okay, so your MAT account debit to like your bank, you pay MAT expense account debit to bank. Then you pass one more deferred tax asset account debit to say MAT expense. You close that. You recognize entire thing as a current asset. The amount of MAT credit is 8.5 on 31st March 2016 and 17 it is 9.75. That means MAT is like deferred tax only asset, because you can get and full amount, not into 30%, full amount. Now can you get this recognize this? Yes, because I can recover this by the end of 8th year. So no problem. The company measured the head office, it is the same question, 40 crores, 22 crores, 1.2525. I told you, no. See, generally institute does one more thing. In one MTP, they mix it, one leg of one, another leg of another. They solve it in different manner. So this particular question is an MTP where that QA limited is a different part. That second part they have taken from the one study material question. So no other temporary differences, 20%, compute the deferred tax liability as well as the statement of profit and loss account and the OCI for the same. Okay, so second part is fine. I think you can do it. First part, deferred tax on MAT. So you can write MAT credit. This is also known as tax credit. There are three things, no? Three conditions you need to fulfill: carry forward loss, tax credit, and your deductible differences. As on 31st March 2017 is 9.75 crore. This is presented as deferred tax asset. Okay, then they asked you first thing, what is the deferred tax asset or liability on 31st March? You told 9.75 is my deferred tax asset. And what is the charge to the P&L account? Second, charge to P&L. Okay, so you have got closing balance 9.75 minus opening balance 8.5. So 1.25 will be the charge. So in step 6 we are going to do it, and that's it. They didn't ask you the journal entries. Only for our understanding, I showed you some entries. Sorry, clear, no students? MAT credit. It's like whatever MAT you pay, you recognize it as a deferred tax asset, provided three conditions fulfill. And one of the conditions you have seen that yes, you are going to adjust it. This is only for our understanding. MAT expense account debit to bank, deferred tax asset to expense. So expense gets cancelled. So whatever you pay, this is treated as a tax credit. Yes, now you pause the video and don't look into the previous question. Okay, or just remember, no? Can you work out the balances? How much is my revaluation and how much is the depreciation? It is the same question actually. So students, you can pause the video and work out for practice sake. Yeah, first thing is we will get the closing balance, which is P&L effect before revaluation is 0.15, which is opening balance without revaluation, and the closing balance without revaluation. So you end up with the 3.45, and then you pass the P&L to deferred tax liability to P&L. Then after revaluation, you have taken before revaluation and with revaluation effect 1.4. So you pass this OCI to deferred tax liability. Yes. So that revaluation is very important. So next we will move on to the tax reconciliation. Actually, there is on a consolidation, no, there are more questions. What I have done from this study material, I have taken those questions to the Ind AS 103. In Ind AS 103, we will solve that, because at this point of time, again, you have to get more deeper. Yeah, in fact, all other things I could have moved also here from there, because once you understand the journal entries for your what is it called, business combination, that becomes much easier. Now, what is this tax reconciliation? See, tax reconciliation goes with the reconciliation, like you have done some working, deferred tax calculations and all you have done. Now, you should be sure, because see, we are doing with one or two adjustments, but in reality, there are so many adjustments appearing, so many disallowances, so many things. So you do one reconciliation. That is reconciliation you may do in absolute number, or you may do in the tax rate. There are two types. It's a new concept for you. Now, in the absolute reconciliation, we provide the reconciliation of the tax expense on accounting profit. Like you got PAT, profit before tax, PBT. What is the tax rate? Say 30%. If you apply on that, what tax will come? That you compare with the actual tax expenses, with the current and deferred tax, versus tax rate. See, what is the meaning of current and deferred tax? Current and deferred tax, when you take it together, this should be profit before tax into, say, 30%. Should it not give you current and deferred tax taken together both? That is the purpose of deferred tax. Now you remember the first example I told you, where first year there was no tax only, second year 30 was the tax. Rather than we brought that 15 tax both the year. So logically, when you take profit before tax into 30%, it should be current tax plus deferred tax. That's what you try to do to see have you missed something. Or tax rate reconciliation you do. How? We provide the percentage wise reconciliation. Like we did certain previous tax calculations. Your first problem. We did this, no? 100 is the profit, 50, and tax liability is 30. First year, no tax liability. Then I showed you without deferred tax liability, with deferred tax, what is the impact? It will come 50, 20, 35, 35. Now, how to reconcile this? Simple. First, you go to the book profit, 50. Profit as per books. You multiply tax percentage, 30%. You should get 15. Have you got 15? Yes, actual tax expense is also 15, which is that deferred tax. Because when you talk about actual tax expense, current plus deferred, that means your working is perfect. If any disallowances were there, you would have adjusted that. Second year, 50 tax expenses should be 50%, 30% on 50. Yes, your total taken together minus 15. Yes, perfect. Are you clear about this reconciliation? So what you are trying to do here is, whatever profit as per books you get, into 30% you do, this you compare with the actual expenditure what you incurred. This is called reconciliation in absolute number. What is rate reconciliation? Okay, you know your tax percentage is 30%. Book profit is 15 and actual tax expense is 15. So this is tax percentage based on the book profit. What is applicable? 30. Is there any adjustment? Not there. So 30 to 30, 15 to 15. Like this reconciliation you give. Now my problem is one simple thing. There is no disallowances. If there is no disallowances, perfect. Everything is a timing difference. No, then you will see something like this. But in balance sheet, everything need not be a timing difference. Something can be a permanent difference. So how that tax reconciliation works, we will see that. We'll solve some problem. Then you understand the tax reconciliation part. Yeah, anything? In doubt was it? Okay, we'll solve this so that you understand it. Question number 47. An entity made an accounting profit of 1 lakh rupees. This is profit before tax. Tax rate is 30%. Now, in computing the accounting profit, a penalty of 10,000 has been considered, which is not tax deductible. That means you got this after deducting the penalty. This is profit after, what is it, profit before tax. But there are no tax impacts of that. What it is? It's a permanent adjustment. That means you will add it back, but never ever you will claim again in the future. Now, what is tax reconciliation statement in absolute as well as the tax rate reconciliation? Okay, for this first thing, always whenever they ask you, give me reconciliation, you need tax expense. How much actual tax you pay? So, working note number 1, tax expense. First, we will calculate the tax expense to give the tax reconciliation. Profit as per P&L, 1 lakh. Is there any disallowances? Yes. So, add back penalty. Is there any depreciation? No. Then is there any other income which is not chargeable? See, this is a very simple problem they have given as an example. They may give you more items, which you will see as we proceed further. Accelerated depreciation will come. How that works? They will give you 2 different jurisdictions, India and say foreign country. How the reconciliation should happen? So, penalty is 10,000. So, 1,10,000. This is taxable profit, tax profit. Therefore, tax expense is equal to 33,000. Tax expense at 30% is equal to 33,000. Now you have to give one reconciliation. Tax expense, see, if everything was fine, as per your books, whatever profit you get, if you multiply 30%, that should be this. But today, no, income tax is differing from your Ind AS. So we will provide one reconciliation in absolute number. So first, tax expense on book profit. What is your tax expense on the book profit? If at all, tomorrow, income tax says, chalo, no adjustments. Whatever profit you show P&L account, I will take that only, straight away pay 30%. Nice, no? One more subject will go from CA final. Tax, if that day comes. So the complexity is there, that is why it is there. So how much? 1 lakh into 30%. But in reality, you are paying different. That is the last item. Actual tax, how much? 33,000. Now that's what they are asking, what the reconciliation, how it is different. That means something is happening, no? You understood? What is the reconciliation? They say that if everything is fine, if you have followed accrual method, if everything was fine, then actual tax is nothing but current tax plus deferred tax. It should have been matching. Then you say that add, you did one add back, which is a permanent adjustment. Temporary adjustments are not going to reflect here because whatever temporary adjustments are there, that you already gave the effect in this tax expense in the name of deferred tax, 15 rupees. Tax expense on penalty. How much is my tax expense on penalty? 10,000, 30%. Yes, this is the reconciliation. So at the end, after you finalize everything, when the partner or somebody, engagement partner sees this working, they get an assurance that yes, they get one reconciliation. Look, this is the profit, this is the tax, this way it is done, all items have been considered. Are you clear, students? Easy, no? Okay, now let us give the percentage in rate reconciliation. Tax percentage as per book profit. Okay, how much is actual tax paid? 33,000. What is your book profit? 1 lakh. So, when the tax was 30%, you have ended up paying 33%. Then how did you get this? Okay, applicable tax 30% plus expense not deductible penalty. What is the percentage wise if I have to express in terms of percentage? Can you tell me? 3,000 was the tax expense divided by 10,000, which is 3%. Yes, this is the reconciliation, that this is what you actually paid over the book profit, and this is what it came. Otherwise, if there was no add back, then I just showed you, no, it doesn't make any difference only. Perfect. Anybody will understand. And it gives an assurance to someone that yes, your deferred tax workings are correct. It is divided by 1 lakh, sorry, not 100,000. The 3,000 on 1 lakh, 3%. Yeah, because when you have taken 30%, it was 1 lakh. No? Are you clear? Yes. So we'll move on to the another example, example 48. In 2012, an accounting, and this is important as compared to previous, entity has an accounting profit in its own jurisdiction, say country A, like India, 1,500, and country B, 1,500. Okay, this year, they have told you the accounting profit of two entities in two different countries. Maybe someone is subsidiary and the parent. And they have given you comparative also, last year how much it was. The tax rate is 30% in A to India, 20% in B. But when I consolidate now, this is like a consolidation, I will have a different expense. In country A, expense of rupees 100 are not deductible for tax purpose. Say, call it a penalty, just like the previous question. Prepare numerical reconciliation for tax expense. What is my step number 1 to prepare reconciliation? I have to find out the total tax expense for the group as a whole, because we are talking about consolidation here. Followed, no? So first write tax expense, calculation of the tax expense 2012, 2011, because they are given a comparative also. What is my profit? 1,500. Should I charge tax on this? Or is there any disallowances? Yes. So add expense disallowed 100, 200. So 1,600, 2,200. Tax expense is how much? At the rate of 30%. In country A, on 1,600, 30% gives you 480. And 2,200, it will give you 660. For this, I need to add the tax of country B. What is my tax of country B? Please tell me. Sorry? %. Is there any disallowances in country B? Not there. If it was there, I would have worked out similar thing there. So straight away write add tax of B. So I made a profit of 1,500, no disallowances, into 20%. 300, 500 into 20%, 100. So my total tax expense comes to 780 and 760. Clear? Yes, now see, I am India. My investors will look when I am preparing consolidation statement, they will consider my Indian taxes. So now let us prepare the tax reconciliation numeric number. So first I start with my profit. How much my consolidated P&L will show the profit? See, 1500 plus 300, no? No, 1 minute. 1500 plus 1500. 1500 is the profit made by A plus 1500 is profit made by B. See, now why I am telling you this question is more important, because ICA, simply giving last year information, they try to create a confusion, and if you open the study material and see, you will get more confused there, the way they have done it. They are not done in this format. Are you clear now? Last year, whatever, so you can add both the people, you get the profit. This is my total. So on this, how much tax was applicable? You can underline this. This is my total profit. Or you can straight away start with the, like previous question, you can start with the tax on accounting profit. That also you could have started with. So 1500 plus 1500 into how much tax is applicable in India? 30%. So 900. Similarly, on 2500, it becomes a 750. Are you clear? This is your starting point. But how much you paid in reality? 780. Okay, 2011 you forget. Let us talk only about 2012. Because what you do for 2012 is same thing you are going to do, no? See, you paid, you are supposed to pay how much? 900. How much you actually paid? 780. What is the reconciliation? How come that difference came? Okay, before that, one penalty is there. No, first let us adjust that. Should I add or deduct? That penalty resulted in increase in tax expense or decrease in tax expense? Increase, because you added back to the profit, no? So add tax on penalty. For country A, there was, we will address both. First, we will address what we have learned previously. So, how much? 100 into 30%, 200 into 30%, 30, 60. So, if I add this 30 and 60, will I match? See, I need to get 780. I am getting 930. What is the difference now? 930 minus 780. What is this 150? 10% differential tax, whatever. You have calculated more, no? So, should I add or deduct? Add effect of lower tax in B. How much? On 1500 profit, which is sitting here, into 10%. 150 bar 500 into 10%, 50. Yes, you are able to effectively reconcile. Simple, right? Understood now? The logic of reconciliation is you take your accounting profit and on that you charge the tax percentage. And they look, this cost should be matching with my P&L cost, what you pay in reality, which is current tax plus deferred tax. This should be including both. If matching, no, then you will come to know, you will have that confidence that your deferred tax workings are correct. Because deferred tax meant to do that purpose only, no. To do this, you have to go through the tax calculation sheet and see what all add back, deductions, extra things have been done. With this, somebody will prepare this. Now, let us do, they asked only numerical reconciliation, rate reconciliation, they didn't ask. Yes, so we will move on to the next question, RTP question. Sorry? No, it is not a deferred tax. It is one of the effect. Like why you took, see, actually if country B was not in the picture there, country B was not in the picture, then on this 1500 into 30% you would have done. Just added this, you would have got one calculation which was exactly matching with the your tax balance sheet. Since country B came, if both tax rates were same, then also reconciliation was not there. Here, only thing you are trying to tell here, look, my actual, my tax expense on the accounting profit and actual tax expense are differing because of one tax difference in the rates. It has nothing to do with the deferred tax. Yeah, because if you see, all these things have intermediate items, has nothing to do with the deferred tax. Everything is items on which deferred tax was not calculated. But balancing item, no, should have been the one where deferred tax should have been calculated. Say, for example, you get one add back which is deductible in the future. Now, on that, if you add it here, no, problem is this will not match. Because on that, you are supposed to calculate deferred tax. You didn't calculate only. You would have caught that. A limited profit for the tax accounting according to the year is 100,000, means 1 lakh. Taxable for the 2011-12 is 104. Okay, 1 minute. A limited profit before tax. Okay, sorry. This is your profit before tax, PBT, and taxable profit is 104. What do you mean by that? That means there must be some adjustment, no? This is taxable profit. This is profit before tax. Okay. Now, what is this for? We don't know. The difference are account of as follow. They have given you the difference. Another style of presenting RTP question. On 1st February 2012, it acquired a machine for rupees 120,000. Depreciation charged on the machine on a monthly basis. So, how many months you provided depreciation? You charged on a monthly basis. 2 months, because 1st February, no, February and March. Under the tax law, the machine will be depreciated for 6 months. That they have got no 182 days logic. So, straight away 60 is the depreciation you calculated in the tax. The machine has got a useful life of 10 years. That means 120 divided by 10, 12. Sorry? That means per annum 12 rupees is the depreciation. For 2 months, 1 month 1, 2 month 2 is the depreciation. You claimed 2 rupees as a depreciation. Under tax laws, you have claimed 6 rupees. 60 rupees. In the year 2011-12, expense of rupees 8,000 were incurred for a charitable donations, and they are not deductible for tax purpose. Okay, now you go with the adjustment there. Let us see. What is your profit before tax? 100. Did you claim the depreciation? Okay, no, sorry, it's not 60. Okay, the life is 10 years. That means per annum 12 into half. This year's depreciation, 6 by 12. You claim 6 months depreciation. That's the logic. No, yeah. Who will give you in the year only 6 years, half of life of its depreciation? 50% not possible. So now profit before tax is 100. Correct? 100, no? Less depreciation, sorry, add back depreciation, how much? 2 as per books, plus donation or penalty, whatever it is, how much? 8. So 10 rupees you add back, minus depreciation as per books is 6. Sorry, as per, yeah, this is as per tax. Oh, sorry, as per tax. How much you get? If you deduct 6, 100 plus 10 minus 6, 104. That's what they said, 104. So in the examination, when they ask you, this sentence may not be available, be careful. That you know our hallmark. Now they gave you, but how did you get this? You got 100, add back depreciation as per books, add back the penalty, minus depreciation as per tax. You got 104. This is my first step. Then you are required to prepare the necessary entries on 31st March 2012, taking current as well as deferred tax into account. Oh, so you have to pass the accounting entry both for current as well as deferred tax. Now, deferred tax is applicable on anything? Is there any deferred tax applicable on what? On the 120, because the book value will be different from tax base, not on this add back. This is a permanent adjustment. So we have to prepare the entries for current, be careful, and deferred. Tax rate is 25%. This is one question. Question number 2. Prepare tax reconciliation absolute as well as rate reconciliation. Okay, so let us do first one, calculation of the current tax. Now you tell me, sir, why we need to do this? Already it is given, no? 104. But why I am doing right now? See, in the examination, if they give you 104, straight away calculate the tax. 104 into how much? 25%. But if at all they don't tell you 104, then you have to write like this. Profit as per P&L account. Understood, no? How much? 100. Add expense disallowed. Depreciation as per book. How much is the depreciation as per book? 2. How did you get? 120 divided by 10 into 2 by 12. Donation 8. So total 10 less depreciation as per tax. 120 divided by 10 into half. Clear, no? 8. So you get 104. Therefore, tax expense comes to 26. And this working was not required. Again, I am telling you, if they in exam also they will tell you the taxable profit. Anyhow, to be safer, to be on the safer side, you can always do it. Not a big issue. You will also be very much clear. Now, what is my accounting entry for this? Current tax account debit to? No. Current tax expense, that's fine. Credit what? Advance tax. How much? 20? Yeah, your assumptions are correct. But since the question is very silent about the advance tax, what you will do on 31st of March? Provisions payable. Your accounting entry will be current tax expense account debit to tax payable. That's what they told me. I started with this. How to recognize? The tax payable should be shown as a current liability. Yes, now let us imagine the balance sheet. We have to calculate the deferred tax. Forget about the P&L. Second, deferred tax. Now, deferred tax is applicable only on one item. So, do I have got a deferred tax asset or a deferred tax liability? Liability. So, what is my PP book value? 120 minus 2, 118. We are done now. What is my tax base? 120 minus 6, 114. So, we have got 4. Yeah, better we can do this format, no? Always, rather than presenting it like this. I can always present you like this. Like, it's very simple and neat. Rather than horizontally, we can present it vertically like this. This is what? Taxable temporary difference. Therefore, DTL at 25% is equal to 1. Are you clear? What is my journal entry? Deferred tax liabilities credit, tax expense account or deferred tax expense account. You can call it anything. Better you call it deferred tax because you present it separately. Okay, you don't mix it with the current tax. So if you see profit before tax less tax expense, you have got two items called current tax and deferred tax. Now deferred tax you take only on those items where it is subject matter of deferring. Balance sheet item. Permanent adjustments you don't take. Yes. So we have to move to the, we have done. They asked me pass the journal entry for current tax and deferred tax. We have done it. Now we need to do the reconciliation. What is my first step for the reconciliation? Actual tax cost. Correct? What is my total tax expense? How much? First time you calculated 26, no? Plus 1, right? If you see the two journal entry, how much you have debited tax expense? 27. This is what we used to do in every question. First we need to find out the total actual expense. Now tax on accounting profit. How much is my accounting profit? 100 into 25%. 25. Are Baba? My tax on accounting profit is 25. But actual what I expense it of 27. How come? What is the difference? Sorry? No. That is as depreciation effect is already sitting here. And depreciation effect is sitting here also because I deducted only book depreciation. No. There is only one item called a donation. Add tax cost on donation. How much is my donation? 8 into 25%. 2 rupees. You get 27. And depreciation will not come. Why? Because depreciation is already sitting here. I don't want to separate. See now, somebody takes the P&L account, just multiply the tax percentage, they get one tax expense as per the profit. If your deferred tax workings are perfect, then this should be this plus your disallowances should be reading this. This is like something like our previous traditional, what is that, P&L approach we used to do, no? So somebody can take the P&L add backs, check all these things and say, okay, your balance sheet approach has given you the proper values. Because if you have made a mistake, somebody would have found it out. Now let us do the rate reconciliation. You're clear, no? So tax percentage on book profit. How much? 27 is your actual cost divided by 100, 27%. Now you are wondering, look, my income tax is giving me 25%. But how come I am ending up paying 27%? So applicable rate is how much? 25%. And donation, tax on donation, tax percentage on donation. How much? 2 rupees on my total profit, because 25% based on the this 27% I got on the profit. No, it's 2%. So we get 27%. Again, your depreciation effect on the taxes will not come because it is already sitting in that 27%. Clear? Yes, there is one last aspect. Okay, so they may ask you any of this question. One is on ESOP. Okay, let us try to understand about the ESOP. See, This is the last aspect, okay? From there, we will solve the big questions, which is mixed questions. Now, ESOP, what happens with the ESOP? Entity recognizes the fair value of the ESOP as per Ind AS 102 straight line method over vesting period in its P&L account. What entry you pass? Employee benefit expense account debit to ESOP reserve. Is there any item which is going to the balance sheet? It's not a liability, no? It is an equity reserve. See, deferred taxes will come on your asset and liabilities. So, one way to tell you, but there is one exception. However, income tax provisions, the deduction will arise later accounting period when the ESOPs are exercised based on the intrinsic values. You have deduction, you have claimed which deduction? You have claimed a deduction based on the fair value on the grant date. You never change it because accounting standard does not permit you to change the expenses. But in income tax, we'll give you deduction whenever they claim based on the intrinsic value of that option. So now comes para 68B. Okay, it is an exception. Understand? Standard says something. It says that which is similar to preliminary expenses, you need to recognize deferred tax asset on the employee stock options. Now, why deferred tax asset is going to come on the employee stock option? Because the carrying amount is considered to be nil. One way to look at it is, I'll explain you why we calculate deferred tax. But one way, why do you say carrying amount is nil? Because I don't have any asset or liability, no. You have got an equity reserve it is. Versus, you have got a tax base which is intrinsic value permissible for deduction. So when the options are exercised, current tax expense will be available, current tax benefit will be available based on the intrinsic value whenever they exercise. So initially recognized DTA will no longer will be required and will be reversed. If the amount is permitted as a deduction in the future, taxation loss is not known at the end of the period, it shall be estimated. That means if you don't know how much we will be getting, you just estimate it. Like today, you estimate how much people, what is the intrinsic value available to me when after 2 years when they vest and take. This is the same logic we have been using in ESOP also. Okay, now let us solve one problem on this. Let us, because with that time I'll explain you. Only one question, okay, because generally it is an odd question for me because of the exception, because it doesn't go with our general understanding. Okay, ESOP though we know, since already we have done, I need not explain you. You work for 3 years, I'll give you shares. Deferred tax, this is what it says. Now, why deferred tax asset on ESOP? Because when you given the ESOP, you pass the entry P&L account debit to ESOP reserve. 2 rupees, say for example. Now, income tax computation goes, say for example, profit as per P&L is 0. And income tax says, look, you have claimed certain expenses. I will not give you any deduction right now. When I'll give you? The day it is exercised. So taxable profit becomes 2. On this, you pay the tax. See, today you have paid a tax for which the deductions are going to come in the future. Is it not like a tax credit? It's like an asset, no. That's why you calculate deferred tax. But how the standard has given one language, beautiful language, they have given one example and they say, no, it is like a deferred tax because the book value carrying amount is 0. In the second year, employee benefit expense to ESOP reserve, again you will add back, but that day you claim one deduction, say 4.6 intrinsic value, not 4, because 4 was on the date of grant. So taxable profit is 2.6 and you get the tax refund in the future. Because of this add back, no, previous, you get one refund in the future. Okay, let us take one example on the exercise of that. And that's what, no, it is maybe when it is vested. And if it see, exercise question comes when it is a SAR. In ESOP, only vesting, no. Exercise means, okay, you vested, but can you take that money? Now, on 1st of April 2011, P Limited granted 1 crore share options worth 4 crores. That means this is my fair value on the date of grant for a 2-year vesting period. So how much expense you need to claim every year? to 2. Why? No variability of the employee, no fair value changes. The income tax law permits the deduction of the tax at the exercise date of the intrinsic value of the options. They will give you deduction only in the future. The intrinsic value of the option on 31st March 2012, this is 1st April, at the end of first year it was 1.6. When 1.6? 1.6 you estimated today, which will be next year end, and you will claim half of this for tax purpose. And as on 31st March 2003, it was in reality 4.6 crores. The increase in the fair value of the option was not foreseeable. Somebody, income tax department is going to shout on you. Are Papa, how come from 1.6 you jumped to 4.6? Because 1.6 is when it is estimated on 31st March 2012 that on 31st March 2013 it will be. And suddenly when you actually came to 2013, the reality was 4.6. There was a big difference in the estimates. But these people say, sir, we can't foresee. We don't know that share price is going, in 1 year share price is going to zoom up. The options were exercised on the last day. Yes, that means I am going to get that deduction on last day. Give the accounting for the above transaction for deferred tax for the period ended 31st March 2012, 13. Assume there are sufficient taxable profits. Why? Because this is a deferred tax asset for me. In the future, again, deferred tax. Again, I need not tell the story. Oh, deferred tax asset comes with 3 conditions I need to verify. Tax rate is 30%. Okay, so we'll solve this. Okay, this I explained to you, intrinsic value part. As per para, see, I don't refer any para anywhere, okay. I ignore that, whatever, wherever they say. But some places, 1 or 2 places, I will refer it because it's an odd thing, it's an exception thing. Para 68B of Ind AS 12, DTA is recognized on employee, on ESOP as carrying amount is nil. Second, tax base is amount permitted for deduction in future. Because here we cannot go with the logic that, look sir, my carrying amount is what I have claimed, 2. Because naturally I understand, you will tell me I have got a carrying amount. What is the carrying amount of ESOP? You said 2. First year you claimed the expense, no? Expense account debit to ESOP reserve. So naturally you tell me my book value is 2. But book value is not 2. That's what I'm trying to tell, because institute through para 68B says that what you sell 2, no, it is not 2, it's 0. So calculation of the deferred tax on 31st December, D it is with respect to the reserve only. That carrying amount is nil because, see, one way of looking at it is not an asset, not a liability for me. That's why I say carrying amount 0. But we refer to 68B specifically because it is specifically given there. So DTA will be, what is my book value? 0. Okay, we'll follow this format. Book value 0. Tax base, what is my tax base? 1.60 into half. Tax base is 1.60 into half, no? Because 1.60 is what is exercisable, which I have to claim next year, which is 0.80. So I get 0.80. On this, am I going to get deferred tax asset or liability? Deductible temporary difference. Therefore, DTA is equal to 0.80 into 30%. 0.24. So on my ESOP, first year, I will pass one journal entry. You are clear, no? So this presentation, I have done it like this. Institute has done this presentation like this only. Okay, previously I never done this, but I feel that this is the best way of doing. You give book value, tax base, do the working and calculate it. So what is my journal entry? DTA account debit to deferred tax income. So 31st March, the options are exercised, right? 31st March. And current tax benefit is available based on intrinsic value of rupees 4.60 crore. On 31st March 2013, the options are exercised and current tax benefit is available based on the intrinsic value of 4.6 crores. Therefore, original DTA no more required. So you pass the entry DT income or DT expense, whatever, debit to DTA. You reverse that. Is it clear, students? So you just reverse it. Yeah, one question, odd question. Because income tax department, like see, for this matter, in my books of accounts, I will claim the depreciation on the straight line basis. Income tax is WD method, accelerated method, less than 182 days method. So it can happen anything, no? So this is what, as per, see, now, in reality, what they are doing, we are not concerned when we are talking about accounts. Maybe, I don't know, you may be thinking you are trying to connect with the income tax, but don't do it. Because we have to look here only from the accounting point of view. What is there? Not required. Maybe, I don't know. You have any idea on option accounting, option taxation in DT, direct tax? Anyhow, once you learn that, no, then you get a very clear integration. Oh, how it happens, how it works here. Yes, that's it. We are done with all the concepts which is applicable. Yes, now we will solve certain big questions which are highly probable questions of the examination. Now, X Limited prepares consolidated balance sheet financial statement. During the year ended, following events affected the tax position of the group. Now, Y Limited is a wholly owned subsidiary of X Limited. We are talking about X Limited only. They have got one subsidiary. They made a loss which is 30 lakh rupees. Now, followed, no? One of the, see, we are talking about a CFS now. Now, what happens in CFS? Your subsidiary and parent are considered as one entity. Their assets, my assets. Their loss, my loss. So, in CFS, if they have made a tax loss, you say it is my loss. Followed, no? But Y Limited is unable to utilize this loss against the previous tax liabilities. They don't have any profits. Now, income tax department says, look, Baba, you prepare consolidation and tell everyone in the world that subsidiary's loss is your loss. But when it comes to actual claiming loss, no, I will not permit it. So, they do not allow Y Limited to transfer the tax loss to other group companies. Otherwise, nice, no? So many people would have done that. In somebody's name, I would have invested there. No, they will do that, clubbing, transferring back. They will not permit me. However, it allows Y Limited to carry forward the loss and utilize against the company's future. Yeah, they say that, look, if one Y has made a loss I will permit Y to carry forward for next 8 years. But I will not permit Y to transfer this loss to parent to set off their income. The directors of Y do not consider that Y Limited will make the taxable profits in the foreseeable future. Now tell me, students, what is your opinion? See, on 3 things deferred tax assets are going to come. One is deductible, tax losses, tax credits. Now on this, I have got tax losses there. Should I recognize deferred tax asset? Why? Because for me, see, I am preparing consolidated. In consolidation, the difference between me and my subsidiary vanish. Then I will start telling theirs is mine. But the income tax says, you say everything is theirs is yours except the tax loss. That's what I can. Okay, what if the subsidiary Y is going to make profits in the future? Then you can get. Then you recognize, no problem. But if that subsidiary cannot make the profits, or income tax amends, or you find one tax opportunity that somehow with a beautiful plan, you can shift this loss to the parent. Official, legal, do it. Followed, no? Are you clear? So this is the theory what we need to write here, that this is not permitted because your tax losses, tax profits, all stories you will tell. Are you clear, no? Yes, now just before 31st March 2018, they committed to itself to closing one division after the year end, making number of employees redundant. Therefore, they recognized the closing provision of 20 lakhs in the P&L account. Income tax says that only when you actually close, I will allow you. In the year 2019, X Limited expect to make taxable profits which will be in excess of 20 lakhs. On 31st March, X had taxable temporary differences and other sources which were greater than 20 lakhs. Now tell me, before we proceed, what is this? What is this? What I am supposed to do when it comes to deferred tax? Deferred tax asset comes or liability comes? Is there any balance sheet item? Yeah, provision is a balance sheet item. What is my tax book value? Book value 20, no? 20. What is my tax base? How? Why? Because income tax says, I will not give you any deductions. That means you passed one entry there to claim the deduction. Income tax added it back. But is it a permanent difference? That's what you need to see, because if it's a permanent difference, then my tax base is also 20. And this will reflect in your reconciliation statement there, tax reconciliation. Since it is not a permanent, it is 0. Now, since it is a liability, and liabilities book value is more than the tax base, you have got a deferred tax asset. Can you recognize? Why? Yes, there is a taxable difference as well as there is excess profit. So why they gave this? Can they twist in the examination? They will restrict it to 18 lakh, say for example. Then, whatever, sorry? 1 lakh. Then, up to 19 lakhs you are going to recognize the deferred taxes, not more than that. Next year, if you get some opportunities, you are going to do it. Followed, no? During the year ended 31st March 2017, they capitalized the development cost, which is 16 lakhs. And the project began generating economic benefits from 1st of January 2018. The directors estimated that the project would generate economic benefits 5 years from that date, and development expenditure is fully deductible against the taxable profits. Now, I just want to ask you, if my tax is 20%, will I get a deferred tax asset or deferred tax liability? Just tell me one amount. Students, please pause the video, do it as per your understanding. Question, you see what happened here, there is one development cost. Can you capitalize this? Yes, so you capitalized it, 16 lakh. When the development project began giving the benefits from 1st of January, during the year 31st March 2017, it's capitalized. The directors estimated that the project would generate the economic benefits for 5 years from that day, from 1st of January 2018, and we are on 31st March 2018 now. Now, what you need to tell me, if the tax rate is 20%, whether I have got a deferred tax asset or a liability. If yes, what is the amount? Yes, students. So please pause the video and do this. Students, since we have not yet done Ind AS 38, what I can tell you at this point of time, my Ind AS 16 is somewhat very similar to Ind AS 38. If instead of development cost, if I would have told PPE, how you would have treated? You have to treat it that way. Followed, no? When it comes to amortization. See, deferred tax is a very simple concept. First thing, I need a book value. What is my book value? Will you say 16 lakhs? No. Why? 16 lakh was up to 31st December. Till it was getting capitalized starting from 1st of March. 1st April to 31st December, all the capitalization happened. Now, since it is ready for use, you start amortization for how many years? 5 years. How many time period is over in the year 17, 18? 3 months over. So, 16 lakh into 1 by 5 per annum depreciation you will get, into 3 by 12, you get 3 months depreciation. How much? 80. So 16.8 means 15 lakh 20,000. This is your book value at the end of the 31st March. Looking at the balance sheet, what is my tax base? 0. No doubt here, because they said very clearly, no, it is disallowed. It is fully deducted. Now, what is the difference? 15.20. On this, 20% comes to 3.04. Deferred tax asset or liability? Liability. Carrying amount is greater than the tax base for an asset. What happened? Where it got confused? You took 16 lakh then. No. Depreciation for. See, again, that's my purpose. No, otherwise I would have solved it. I want you to figure out why it was not clear to you, what mistakes you make. Otherwise, no. Tell me, is it not looking very simple? Damn simple, no? Okay. On 1st of April, they borrowed 1 crore and arranging the borrowing cost, transaction cost is 2 lakh. They will repay 1 crore 30. Income tax says 30,000 we will claim on the payment basis. But the fun here in this problem is not these numbers. That anyhow you can do. How do you explain and show how it is going to affect the deferred tax in the CFS as per Ind AS? How do you explain it? One is doing calculation, that is show. Show is nothing but a calculation. How do you show the effect? You say, this is the calculation, 3.04, that is the calculation. But how do you explain the effect of it? All these 4 items. Okay, so we'll solve this, we'll write, and when you're writing, please pay attention what we are writing. The tax loss creates DTA as book value is equal to 0, tax base is equal to 30 lakhs. We say that because you have to explain. No, explain means explanations, the effect or accounting treatment. But do we recognize? No, but we do not recognize DTA as 1. No taxable profit anticipated. In the future, you are not expecting any taxable profit. Second, tax loss cannot be transferred. That means you don't have any tax planning opportunity also. They have just blocked it. They said that we will not permit you to transfer it because of these 2 reasons. Even though a tax loss is going to give me a deferred tax asset, I don't recognize it. Finish. Enough. 1 or 2 months. Clear? Is this explanation sufficient? Do you have anything to show here? No. If calculation is there, then if they would have asked, if I have to create a deferred tax, I would have calculated and shown it. Second, deferred tax on employee benefit. We have DTA of rupees 4 lakh, which is 20 lakhs minus 0 into 20%. DTA can be recognized. 1. X Limited expects to generate taxable profit. And there are taxable temporary differences greater than 20 lakhs. This DTA is presented as deduction from DTL, if any. Are you clear? Yes. So we showed that 4 lakh is the effect, and this is the, okay, maybe 1 mark or 2 marks for this also. I'm not sure. I will go with the worst case, 1 mark. 1 mark, this is what I am going to write. Are you clear? Yes. The next is deferred tax on the development cost. Third, deferred tax on development cost. Cost capitalized. How much? 16 lakh minus amortization how much? 80,000. 16 by 5 into 3 by 12. Clear, no? Book value minus tax base 0, 15 lakh 20. Therefore, DTL of rupees 3,04,000 is shown as non-current. This is a non-current deferred tax liability. $3,04,000 is a non-current, because when? Why non-current? Why non-current? When it's going to get reversed? Huh? Over a period. It's going to get reversed over a period, so it's a non-current right now. The last one is the on loan. Deferred tax on loan. Okay. What is your borrowing? You know this. It I will calculate. Borrowing on 1/4/2017. How much? 1 crore. Yes, Vishnu, we are clear, no? What we are doing? Any doubts? Yeah, anyhow, next 2 days, no? Please go through this standard, because once we go to the consolidation, often here and there we'll apply, but not to this extent, no theories. Straight away we have to figure out the difference between book value and the tax base. Now, what do we do it? Now, what should I do next? I want a closing balance. Transaction cost, add or minus? Minus transaction cost. How much? 2 lakh. Now you got the 98 lakhs as the initial recognition. add interest at EIR of 10%, 9,80,000. So you got 10,07,080. 1 crore 7,80,000. 1 crore 7,80,000. This is your book value at the end, correct? What is the tax base? Yes, Tanushree, tax base. Huh? Sure? Yes, Vidya, tax base. I have to deduct the tax base, no? Question may be silent about transaction cost. We can assume here that income tax permits it. So what is my transaction tax base? 1 crore. Why? Because Income Tax Act permits the deduction, and they said that 30 lakh rupees they will permit only when you pay. So whatever loan you have taken on day one, that only will remain. Whatever transaction cost you paid, they treated it as an expense. They didn't need to go to the balance sheet of the income tax. You have to just think what affected their balance sheet value. Nothing. Clear? So on this, what you are going to get? That deferred tax asset or liability. So you get the difference of 7,80,000 rupees. This is deductible or taxable? Deductible temporary difference. Therefore, DTA at 20% is equal to 1,56,000 due to profit in subsequent year. We can recognize DTA. Clear? Yes. Next question. Okay, it is a very similar. You can take it as a homework also, I think. Next question you can solve it. Because see, in this chapter, no, I am feeling like till 27, I think every question we solve together, no? Almost. See, in other chapters, so many questions I used to tell, do you do it, do you do it? Here, because very limited, because each question is a little different only. Theoretical, much is more theoretical here. Now, PQR is a manufacturing company, prepares a consolidated balance sheet, wholly owned subsidiary, tax loss is there, 30 lakh rupees, they can't carry forward it, neither they can transfer it. They capitalize the development cost of 16 lakhs, they started from 1st of January, 31st March. Again, this is a mixed question. They have got a borrowed 1 crore, 2 lakh is the transaction cost, 1 crore 30. It's the same, actually, in fact, repeat question. I don't know why I kept it separate. Okay, so I'll just proceed it. So again, you will say that, look, tax losses are there. You cannot transfer, so no deferred tax asset. Then you have got a development cost. You calculate the book value 15.2. Tax base is 0 because you have claimed full. So you will show it as a non-current asset 4.56. And the last one is the loan. You calculate the closing balance 1 crore 7,80,000. And from there, 1 crore you deduct and say deferred tax asset. We are going to calculate and present it as a deduction from deferred tax liability. Yes, next question, students. Yes, you can. Is that ditto same thing? Huh? Okay, please pause the video, students, and do this. See, let us solve one examination question. See, you have seen now, and we have done some 2 questions also. See, when this question came in the examination, yeah, it is actually a repetition only. But you see, is there any difference? Try to solve it. Okay. See, that's what my point to tell you. It need not be the same thing what they will give you. It looks same, but there will be some catch. Yes, students. So please do it. Let's compare the answers. If theory, please write the theory, okay? Don't skip the theory. Write the theory also. Let me see what points you will cover versus what points suggestion and answer will say. Yes, students. So we'll check the answers. Okay, feeling good that one examination question came and I'm telling you to do it so that you understand what happens. Okay, first part of the question is plain, I believe, correct? So you must have written here, tax losses cannot be carried forward, so cannot be given, so we'll calculate deferred tax. How much mark do you think? 2 is on a best case scenario. If you ask me, I'll go with the worst case scenario of 1 marks for this. Why? Yeah, I would have done that provided this was not there. I will allocate to 2 marks for this because they are required to examine whether the effective interest rate, whatever they told. Then when it coming here, is this the same ditto of the study material? No, they change the language here to create a confusion. As per income tax, further expense of 15.21. What is 15.21? The difference between 50 and this will be claimable from the taxable income till the loan is repaid. So on what basis, Baba? What is this something new they added here? Till the loan. If you go back to the study material question, they told very clean categorical language that it is claimed only on the payment basis. Here, what they are trying to tell me? You start thinking, should I split this into multiple things? That is what you should not touch this. You have to figure it out. It is not the same question. Okay, after doing this, see now, still if you are not clear, see what assumption you will tell. Will you say half? Nothing, no assumption. I don't think, if I am in your position, I am really not able to think what assumption to take and how to claim this. I would have gone with the study material assumption that it is claimed at the end of the year. Adadagi. Whatever comes, let it come. Okay, so now you have to make an assumption that they have claimed at the end. Since the question is very silent, otherwise they would have told you in which pattern they would have claimed the deduction. That they didn't tell. So you must have done this also, I hope, taking the study material assumption. Okay, now comes very important part, because my theory is already there. Institute don't want to give you 0, Institute don't want to give you 6 also. What is that extra fitting they said? You are required to examine whether the effective interest rate, EIR, for the loan of 50 lakhs is as per applicable Ind AS. What is your EIR here? How did you prove it? Whether it is it correct? Is that EIR correct? Yes, it is correct. Yes. Who attempted? Did you attempt? Yes. Okay, good. And I think 2 marks should be allocated to this. 1 mark, just, Are Baba, they asked what? You try to understand now. Now it looks simple if I explain it. They said, look, whether the EIR of 10%, is it correct or it is wrong? How to know? Simple. You prepare one amortization schedule. If this 50 lakh will turn out into 65.21, you say EIR is correct. So what you need to prepare is one small amortization schedule. And give one note that since amortization schedule is tallying with 10%, it means that the parent calculated EIR is correct. Tell me, is it not conceptual? That is concept. First one is the procedure. In fact, this is also a procedure. 4 marks is worth procedures here. 2 marks worth concept they added. Clear? Yes, I will proceed further. So first story, same thing, no deferred tax is going to come. Then the second part, calculation of the deferred tax. You have got the carrying amount of the loan is 53.90, which is 50 lakhs minus 1 lakh into 1.10 at the end of the year. Why you need to calculate and write? You can calculate like this also, no? And expense of 15.20 deductible in the year of payment for the transaction cost qualifies for a tax deduction. Have they told you about the transaction cost? Yes, they have told you. So base is 50. So you have got 78 lakhs as the deferred tax asset. Now the third question they asked you. is this matching? So you start with the opening balance 49,000, 49 lakh. Why? Because 2 lakh transaction cost deducted. And you prepare an amortization schedule, you exactly get 65 lakhs 21. With this you say that yes, you give one comment, since the loan closing balance is going to match with this balance at 10%, that means EIR is correct. You see, another way they ask you about the EIR. Clear? Yes. Another beautiful question. Okay, I want you to solve. See, you have understood now deferred tax quite. An entity is finalizing its financial statement for the year ended 31st March 2012. Before 31st March 2012, government announced, okay, now you are on 31st March, not 31st December. And just before that, the government announced that the tax rate is to be amended from 40 to 45% for profits from 30th June 2012. Now, question comes, will you take 40 or 45? Okay, for this we need to know whether this announcement is substantial. See, the legislation to amend the tax rate not yet approved by the legislature. However, government has got a majority. That means it's just a matter of the procedure. What they say it's applicable there. And announcement having a substantive effect. That means it's going to happen. So I am going to go with the 45%. But problem what happened now? After performing income tax calculations at the rate of 40%, the following deferred tax asset and liability balance came. They didn't know. So or somebody calculated deferred tax asset and liability balance with the 40%. But then the news came. Government told like we are going to do it. By that time you already calculated. Of the deferred tax asset balance, 28,000 is related to the temporary difference. This deferred tax asset has been previously recognized in the OCI and accumulated in equity as a revaluation surplus. That means the deferred tax asset you gave, no, this has got two breakup. One is related to one surplus what you created. On that 28,000 deferred tax asset came. Where you recognized? OCI, we have done that. Revaluation surplus, we split one amount, 1 lakh we took to the P&L. The entity reviewed the carrying amount of the assets as per 56 and determined it is probable that sufficient future taxes are going to come. That means, yes, deferred tax I can recognize. Note, one of the three conditions is fulfilled here. I got sufficient taxable profits in the future. Now, can you show me the revised deferred tax asset and liability and present the necessary journal entries? Nice question. Not nice, beautiful question. So what you need to do is, you have to calculate the revised, how much additional? Already they have done it at 40%. This is at 40%. You need to tell with the 45%, that is what is the impact of that 5% increase, you have to tell. But along with that, they told you one more thing, give the journal entry. When I give journal entry, my problem is 1 lakh go to that OCI house. So think over it, students, and just pass the journal entries also. We'll see, we'll compare. Question is clear, no? Any doubts anybody is having? No doubts? Students, see, again, I think I told also Albert Einstein's one quote. See, Albert Einstein says that if 1 hour is given to him and he has to solve one life and death question, he says that 55 minutes he is going to spend on the question. Because he says that if I have understood the question very well, I will solve in 5 minutes. The point is simple. If you have not understood the question, despite whatever efforts you are going to put, you cannot solve it properly. So spend time in reading the question, understanding what exactly they are trying to ask. Look into every words what they have told. Spend time. Don't jump. Don't do hurry-burry. Do hurry-burry for your solution. You take shortcuts in the solution, like not filling certain columns, writing some shortcuts, writing something like consolidated balance sheet. First you prepare the face of the balance sheet with a pencil, leave some space. That's all shortcuts you do. But when it comes to question, no shortcut. Followed, no? Yes. Okay, let us compare. And one more thing. See, I need a presentation in FR that I want to tell you very clearly. See, like this type of presentation, if you have done in your working, say DTA is equal to 80 lakh into 4 by 6 divided by this thing, that is meant for AFM. AFM you can do this type of thing. No, you have to tell what is this 80. In FR they expect you to do this. I don't know how much mark, whether they award mark, they will deduct mark, what. But the general expectation is you have to give in the form of some table, explanation, followed. No, any equation based, don't do that type of work. Take it as a learning. So first you say that in the given case, you have got, okay, theory, the question is not using any verb. They say show the revised amount. So literally calculation. So instead of 45, we are going to recalculate 45 instead of 40. And there is a 28,000 meant for OCI. So we will provide it like this. See how much you have shown in OCI, 28,000. How much in P&L, 52,000. How much in P&L, DTL, 60. These two together comes to 80. You divide it by the tax rate, 40%. Or you can give an item called a total deductible meant for OCI, 28,000 divided by 40. Followed. Now I want something like this, like you write in this, write the amount, total deductible for OCI, total deductible for this, some presentation I want. Then you got this 71 lakh, 31 lakh, 50. Now see, 40% gives you 28. What do you need to do? You need to do 45%. No, just take 45%. You get the total, or the 28,000 already you passed the journal entry. You wanted that additional 5%. No? Take 5% of this, you get the values. So your accounting entry will be, what is your accounting entry? So alternatively, if some students want to do it in an alternative way, that can be, you can present it in a different way. 45% is the revised tax rate. This is your deductible difference. This is the total tax should have come minus currently so much accounted. This is the difference. Followed, no? 70,000 is the total deductible. Into 45% gives you the revised deferred tax, which should be there in your balance sheet. Minus what you have done already previously accounted. So 3,500 should go to OCI. This should go to P&L. So deferred tax asset is going to increase by 10,000. And deferred tax liability is also going to increase by 7,500. Yes. What confusion? Any confusions? Now looks simple, no? Easy, right? Yes. Now your accounting entry will be deferred tax asset to revaluation surplus. See, you have to take it to OCI only along with that concerned deferred tax to deferred tax expense, because you are, and your deferred tax expense to deferred tax liability. Yes. Anything? Any doubts? Okay. Overall easy. Anyhow, you can give a low priority for this. I think it's not a study material question. No? Study material question. Have I given NSB or something? No. Then you please see this. Highly probable questions. Exams, I don't think so they've asked till now. Since in the initial migration, there is a possibility that they may ask you these unasked questions in the first 1 or 2 attempts. Then probably they may revert back to the original questions. Yes. Next question. On 1st April 2011, this is very easy. S Limited leased a machine over a 5-year period. The present value of the lease liability is 120. It recognized the lease liability and corresponding ROE asset on the same day. ROE is depreciated on the straight line basis, and lease length of 330 crore is payable every year. But the tax law permits the deduction not on your ROU and interest expense, but on the payment of rent. Assuming 30% is your tax rate, you are required to explain the deferred tax consequences for the above transactions as on 31st March 2012. How do you explain it? What you will tell?
Expenses are charged by 10 crore.
Okay, so you are going to claim the which expenses? Depreciation on ROE asset. And so you start, see this word, what is the meaning of the word explain? Explain means you start explaining something like substance by giving your more. And if somebody is not clear, you start explaining more. You say that, look, expenses are there, not claimable as a deduction. So what is going to happen there? What is the tax base? Tax base is the payment of rent. So deferred tax will come on what? Deferred tax will come on the expenses, or deferred tax will come on something else? Which is my balance sheet item? RO asset only and lease liability. I have got two elements. On that, deferred taxes are going to come. How much, like, what is that called? What is the tax base of that? What is the tax base of an RO asset? Lease liability? Why? Somebody may ask you one question, no? Why you are telling RO is 0? Lease tax base is 0.
Directly to profit and loss.
How will you tell like that? Reasons are, what you tell me in the language of income tax? You tell that, no. Tax law permits tax deduction on the payment of rent. They don't recognize. Tell the language would be written there only. You tell that. What is the reason you are not recognizing it? So will the deferred tax asset or liability is going to come? Because I need to explain the tax consequence, no? Question is clear? Will you get deferred tax asset or liability? Come on. Hey, don't leave my hand now like this at this point of time. You have done almost 4 more questions now. And deferred tax asset or liability? You say both, no, Baba. Because you have got an asset, RO asset. Its tax base is 0. You have got a deferred tax liability. You have got a lease liability whose tax base is 0. You have got a deferred tax asset there. Both will net. So instead of you calculating separately, can't you do the net of RO asset and liability together and find out one? Because tax base is 0, no, for both. Net effect you see and tell me. But will my closing balance is same? Net effect when I am going to calculate, at the beginning or at the end of the year? End, that means end of the year, my balances are different, no? Today my balances are same. End of the year balances are different because ROU asset depreciated, lease liability amortized. So I need to figure out what is my closing balance of ROU asset and lease liability at the end of the year, net off together. Why? Because ultimately the deferred tax, if I calculate, one leg asset, one leg liability, ultimately I net off. This net balance I will compare with the tax base, which is 0. On that I will calculate deferred tax and say, this is my deferred tax impact. Why? Because both will go to P&L account only. If depreciation would have been going to OCI, then I got a problem then. Then lease liability part I will take to P&L, depreciation part I have to take on to OCI. Yeah, but we have to prove it, Whatever it is, we have to just prove it, like whatever, like what is my balance at the end of the year? Is my liabilities more than that? Yeah, liability will be always more than that because it is the expense that amortized, Your depreciation is on a straight line basis, straight away big amount will go as a deduction. Yeah, we end up with the deferred tax asset. No, your liability is more, net liability is more than the tax base, Net liability will be more than the tax base, Carrying amount is more, okay. So we'll learn how to write this illustration 2, very important question. Write solution. So many things are there. A temporary difference arises between lease accounting as per Ind AS 116 and as rent is deductible on payment basis. You claim the deduction of depreciation, tax base of ROU and the lease liability is 0. Therefore, deferred tax. Okay, wait. So this is some theory you will write. Tax base of the machine will be nil. Tax base of the lease liability also will be nil, because you claim the rent on payment of the lease rent. Instead of this, you claim the depreciation on the lease rent expenses. So what is your closing balance? Okay, next you say closing balance of, we'll club it together. Calculation of deferred tax. Book value of ROU at the end. Can you tell me how much? How much is my book value of the ROU at the end of the year? Yes, everyone, Vishnupriya. How much is my book value of the ROU? Yes, Kriti, how much you got? $96. How did you get 96? See, you have got a 120. This is depreciable over a 5-year period. 24 per year. So you got 96. Less book value of lease liability. Yes, how did you get 99.6? 120. Amortization schedule. 120 is your opening balance of lease liability. Okay, into how much? 1.08. You get with interest balance minus 30 lease payment. You get the closing balance now. 99.60. So your lease liability is more net 3.60. What is your tax base? Already you told 0. Tax base is already 0. So 3.60. Are you going to create a deferred tax asset or liability? This is, you say, net. This is net liability, and this is deductible temporary difference. DTD. Followed, no? This is deductible temporary difference. So you will calculate a DTA at the rate 30%, which is 1.08. Okay, I have presented it this way. So calculation of the carrying amount I have done separately. I have presented it this way. I will change it. Horizontal thing, I will present it as a vertical. So you have got 1.08 as a tax rate. Clear? Okay, no?